Good morning from London. I'm Anna Edwards alongside Guy Johnson and Chrissy Gupta. We're an hour away from the opening trade. Here's what you need to know. Phillips raises its guidance, saying the tariff impact isn't as bad as feared. We will bring you results from Barclays, AstraZeneca and Stellantis in a moment. Trade talks between the world's two biggest economies roll into their second day in Stockholm. US Commerce Secretary Howard Lutnick says a 90-day extension of trade truce with China is a likely outcome. Plus, the euro tumbles the most in 2 months from its 3-year high. Leaders from EU member states start to criticise the US trade deal.
A quick check on the markets in the meantime. You are seeing a little bit of risk-positive sentiment here. Your stock 50 futures higher by 0.5%. S&P futures on the back foot this morning, but still in the green, higher by 0.2%. Anna was just there talking about that euro-dollar story. We are barreling towards, I won't say that 114 handle, 115.78 on euro-dollar at the moment. And, of course, one eye on Brent crude, kind of getting whipsawed by the news around Donald Trump's 10 to 12-day deadline when it comes to Russia, plus the readout from those trade deals. The countdown to the opening trade starts right now.
Tuesday morning, good morning. Was yesterday the day that the Europe trade died? The first half was dominated by it. Will the second half? Well, we're about to find out what the corporates across Europe think about that trade deal that was done over the weekend. We're starting to get some numbers coming through. And initially, certainly from the car sector, the news not entirely positive. Remember, Stellantis warned us a few weeks ago about what was happening with its earnings. Its numbers now drop onto the screen, and it's able to quantify to a certain extent what that tariff hit is likely to look like in the second year. It sees about 1.2 billion euros in net tariff impact in the second half of the year. Its first half operating margin weaker than anticipated as well, coming through at 0.7 versus an estimate that was close to 2%. So there is a hit coming through already for one of the more obvious sectors that we are going to see a tariff impact in, and that is the car sector. Are we going to see, therefore, some significant changes at Stellantis? What is going to happen in terms of its cash burn going into that second half? Will it need or be able to continue its dividend at current levels? Key questions, I think, for management on that call a little bit later on. Anna, we also get Barclays, the banks, the best performing sectors so far this year. What is happening there?
Yeah, absolutely. So some numbers coming through from Barclays. The second quarter investment banking revenue is one of the headlines that has gone red, a hot headline across the Bloomberg terminal, because that has come in a little ahead of estimates. But in fact, the investment banking story is a little confused here, because they're also giving us some other details around investment banking, and the fees there have come in lower than anticipated. So we'll put investment banking to one side for one moment. Loan loss provisions coming in better than expected, so that's good. FIC revenue and equities revenue coming in better than expected. So on the trading side of things, clear that this is a business that, just like many others within the sector, has been doing quite well out of the volatility. So second quarter equities revenue, better than expected. FIC revenue, better than expected. They're also initiating a share buyback of up to £1 billion. So a lot that the market will find to like about the numbers here. But an interesting conversation still ahead then on some of the dynamics beneath the hood here, particularly around investment banking and what expectations the CEO, CS Venkatakrishnan, has around that part of the business.
Absolutely. And Barclays also talking about a buyback of up to £1 billion as well. So we'll see if that is well received by these markets. Sticking with the UK, though, quick check on AstraZeneca, because those earnings are coming in bang in line with estimates, which is exactly what analysts were expecting. Their corporate EPS coming in at about $2.17, which is exactly where the estimate lied there as well. You are actually seeing their revenue come in slightly better than expected when it comes to their second quarter, 14.5 billion, we'll call it. The estimate was about 14.1 billion. So marginal progress there. Where you are seeing a little bit of weakness is in their profit margin. Their core operating margin coming, again, bang in line with estimates, but their profit margin is slightly weaker as well. So a little bit of a mixed bag in terms of showing resilience is what we're waiting for when it comes to AstraZeneca.
Yeah, I think we're going to wait and see exactly what happens, particularly with the pharma sector, one of the key areas that we're going to be watching as a result of the trade story. Do we have clarity now in terms of what the tariff hit is likely to look like? It's interesting that certain businesses this morning are able to maybe quantify what we're seeing in terms of the hit that they are likely to take. It's interesting, Phillips is up really sharply this morning. We're going to talk to the CEO very, very shortly on his numbers, but the stock is up really, really strongly on the idea that actually the trade hit is not as big as anticipated. Therefore, they've been able to raise some of their numbers coming through.
Yeah.
In terms of the trade story, though, there's a lot still going on.
Yes, and it seems that our focus is on Stockholm, partly, and this conversation that's happening between China and the United States. Howard Lutnick then saying that it is likely that we get an extension, 90-day extension to this. But let's remember what this is an extension to. It's an extension to a truce. It's not perhaps aiming to bottom out all of the areas of tension between these two parties, and it certainly doesn't seek to address all of the drivers of the trade imbalance that exists between these two economies. But the fact that tariffs are not escalating one on top of the other is a positive, I suppose. Trump has suggested that he might be meeting Xi. He might go to China. This has been an ongoing topic of conversation within the media and the US administration over the last month or so. Latest headlines suggested maybe that happens in October, but we'll have to wait and see whether that comes to pass.
Is this just the permanent state of affairs? We just keep, like, 90-day extension? Yeah, let's have another one of those. We'll just keep going, keep
only
doing that.
With China,
how long can you carry on?
Only with China.
Only with China, though, right?
Maybe India as well. We'll see what happens on that front.
Yeah, but I guess to your point, that's like the biggest one that you need some clarity on as well. I thought what was interesting is that you might point out the iron ore move this morning, perhaps in favor of it, but the rest of the commodities not showing that same sort of optimism that perhaps you see in that one commodity as well. I've got one eye on the currency, especially if we're talking about the currency manipulation label that the White House has put on there, and is a key part of those negotiations.
The market yesterday was like, Europe's over. Deal is not a good one, as a result of which Europe is going to suffer more than the United States. That certainly seemed to be the narrative yesterday. There's a lot of grumbling from Paris, from Berlin, from various other places. I can't help but believe that they would have been told by Ursula von der Leyen what this trade deal is. So this feels like it's playing to the domestic gallery.
Yes, maybe it speaks well to the, as you say, domestic gallery, the reservations they're now expressing. Also, they have to get this through this legal text. Well, no one's seen the details. All we know is what President Trump said. We haven't even seen the agreement. They're still trying to get an agreement in some kind of paper form by that August 1st deadline. And then we need a legal text, and the European leaders will have to agree on that. And so no doubt there'll be a lot of rhetoric and pushing back from various quarters based on that. But the implication here is so complicated, isn't it? And we'll get into this with lots of different sectors and lots of different guests. But even within the car space, I was reading some research from UBS, there are some companies that had assumed this would be worse, and some companies in their own guidance had assumed this would be better. And so from there, you're from a different starting point. You're assessing the value of this deal.
Well, from an index level, people were expecting anywhere from 10 to 15%. We got the higher range of that. And therefore, in some people's minds, this is a priced-in deal. Let's talk about what else is coming up, at least from a data point of view, for the rest of the day. 9 a.m. UK time, ECB inflation expectations are going to be crossing the wires. Plus, of course, earnings season. We're talking about earnings season here in Europe. It's earnings season in the States as well. Boeing earnings are going to be crossing the wire as well, alongside plenty of data ahead of the payrolls report on Friday. U.S. JOLTS data coming in at 3 p.m. UK time, plus that U.S. consumer confidence. And as promised, plenty of data, or excuse me, plenty of earnings right here in Europe as well. L'Oreal and Kering reporting after the European close.
We'll see what they had to say on trade as well. We've got plenty of guests already this morning that are going to be joining us talking about that trade story in terms of the numbers they posted this morning. Actually, the banking sector has been the best performing sector so far this year. Barclays is not the best performing bank within that sector, but the whole sector's done incredibly well. CEO Venkatakrishnan is going to be joining us very, very shortly. The CEO of Barclays will get his take on what is happening with the global economy, what's happening within the banking sector. Can the current outperformance of European banks be sustained? Roy Jakobs, Philips CEO, is going to be joining us as well. They are one of these companies that actually assumed a worse figure on trade, and as a result of which this morning have been able to upgrade their numbers. And clearly we are therefore in a situation where actually those numbers could translate into a big pop this morning in terms of the stock. Maria Minucci is going to be joining us, M&G fund manager, talking to us about the market's take on this from an equity point of view. And Isabel Mateos-Ilago is going to be joining us from BNP Paribas, chief economist there. What kind of a hit should Europe expect as a result of these 15% tariffs?
OK, let's put the trade conversation to one side for a moment and get an update on one of the stories we've been waking up to here in Europe this morning. A gunman has killed at least 4 people and himself in a shooting in New York City. The attack took place in a tower in Manhattan that houses the global headquarters of Blackstone. Staff at the company say they pushed furniture against doors to barricade themselves in during the attack. The gunman was found dead on the 33rd floor of the tower. Welcome back. This is the opening trade. We're deep into earnings season, of course. Barclays reporting numbers this morning, and plenty of them coming in ahead of expectations, and the company announcing a share buyback. Let us talk to the CEO of Barclays, CS Venkatakrishnan, who joins us now. Venkat, very good morning to you. Thanks for joining us. Let's start with the performance of FICC and equities, where we seem to have numbers that come in better than expected. Clearly, trading volatility has been good for a lot of banks within the sector. How sustainable do we think that is into the rest of this year?
Look, I think we have built on extremely good foundations. Thank you for having me. I'm very, very pleased with these results, not just for the tremendous strength of this quarter's performance, but because what it has built on over the last 6 quarters of growing increased performance and what it forebodes for the future, what promises for the future. So this quarter, top line, £7.2 billion, up 14% over the previous year. Profitability, £2.5 billion, up 28% over the previous year. Earnings per share up 41%. The investment bank, as you say, beating in markets, in equities and FICC. I think we may be the only bank reporting so far that have done both. And then the beat in investment banking has been above consensus for the 6th consecutive quarter. And each quarter the beat is higher than the previous one, this time over 300 million. So all around, we're very happy. And the shareholder distribution up to £1 billion this half year compared to 750 million a year ago. So on all fronts, on all cylinders, I'm very, very pleased with this performance.
So you're very pleased with all of those things that you mentioned and all areas of performance, you say. Just diving into part of the investment banking landscape, investment banking fees coming in a little bit lighter than had been expected. I mean, is this down to IPOs and M&A and a lack of those things happening, Venkat? What's your latest thinking on when we get to a return to activity there?
Look, I think we are beginning to see the return to activity. I think on the market side and the banking side, we've been making tremendous structural progress in terms of capital discipline, in terms of share with our top clients. On top of that structural discipline, we've had a tailwind cyclically in markets from the volatility. That's been a bit of a headwind in banking, but that headwind is dissipating and we're seeing activity pick up.
Venkat, good morning. It's Guy. Can I just kind of pick up on those sort of tailwind, headwinds comments that you've just been making there? Since the beginning of 2024, Barclays is up, let's call it circa 130%. This year, the banking sector in Europe is outperforming massively every other sector. There is a huge tailwind behind the entire banking business in Europe at the moment. How much more gas is there left in the tank on that trade? How much more of a tailwind is there still to come? Yesterday was a really interesting day. There was this kind of view in the market that maybe the Europe trade had hit the buffers, that we'd come to the end of that narrative. What do you think?
Well, look, I think I'll speak for the UK. I think the macroeconomic circumstances in the UK are poised to get better. There is a affinity to the financial sector now that's being expressed, the realization of our importance for the economy, and an impetus towards better, more sensible regulation overall. I think that will help banks. I think it will help international banks like us. And I think we've had macroeconomic stability in interest rates, in employment, and growth, while it is slow, is still reasonable. I think in the UK it's around 1%, and we hope it can be higher. But all the circumstances are coalescing. There's a constellation of ideas and energy and activity which will help spur growth. That's what we are confident about.
Well, Venkat, let's talk about some of that activity, because one of the big reasons that a lot of that banking sector has been rallying has been not only buybacks, which you're announcing today as well, about to the tune of £1 billion, but also a lot of M&A in the space. I think you've had a recent kind of brush up with one specific one around TSB and your bid there. Walk us through your thinking around that bid, how that would have helped Barclays in the absence of that bid going through, where you may look next for that same value add.
Yeah, so the Barclays announced in our strategy about 6 quarters ago is very focused on growing our risk-weighted assets in the UK. We set a target of £30 billion from 24 to 26. We're at £17 billion. 10 billion of that has been organically. We've also said we look where it makes sense for things that give us scale, things that give us capability, but at the right price and with the right ability to manage and integrate. I can't comment on any specific situation, but if we do something, it's going to meet all those criteria.
Well, Venkat, do you feel like Europe right now is kind of living up to that moment? To echo Guy's points there, this idea of deregulating, this idea of making those acquisitions easier, not just in the UK, but abroad in your international businesses as well?
So I think broadly M&A will increase as there is more stability in the macro environment. Of course, each company, each bank, each situation is very different. But I think there are rewards to scale. I think those rewards to scale will be realized. We are happy to have many, many businesses at scale, and we know how important it is to protect and to grow that scale. And new technology will only facilitate that and, in fact, increase the returns to scale. So I think that's what companies will be looking at.
Venkat, final quick question from me. How is AI impacting the business? How are you seeing it evolve right now? And in particular, how is it affecting the more junior members of staff that you have on the books right now and are thinking of bringing onto the books into the future? Is that where the biggest effect is right now? And how do you develop a talent pool at the same time as integrating AI into the business? How complicated a process is that, and what are you seeing right now?
Look, I think it is a very complex, but it's a very exciting process. And in fact, the most energized employees in the Barclays system are our junior employees. We've had 2 years of what we call hackathons. Thousands of entrants, thousands of applicants coming in with their projects and their ideas, and we select and fund a bunch of them. And most of them come from junior people who are seeing better ways in which to adopt the technology, make their lives better, and actually help them focus on more value-added tasks. So I think this is a technology and a tool we've made available to all our employees, and I think the revolution will come from the bottom up and from within, and that's the greatest scope. They will make their jobs better for the next 30 years, and that's what we want.
CS Venkatakrishnan, CEO of Barclays. Sir, thank you very much indeed for your time this morning and sharing some of your thoughts. Let's carry on the conversation and talk about how, in particular, the trade story is going to be impacting businesses across Europe. Earlier on, we were talking about this idea that some businesses had anticipated a worse outcome on the trade front, some anticipated a better. One company a few weeks ago that put out some notes relating to how the trade story is going to impact their business was Philips. Today, actually upgrades its numbers on the back of the 15% deal that we saw over the weekend. And what I'm seeing already is quite a sharp pop anticipated in the stock as we start to price that in. Roy Jakobs is the CEO of Philips and joins us now. Roy, good morning. Thank you very much indeed for your time. Let's start with trade. Looks like the stock is going to be sharply higher this morning. You've upgraded your numbers now that you have clarity on what the trade story looks like, and it looks a little bit better than anticipated. Can you quantify what that hit is going to look like, what impact it's going to have versus the numbers maybe you put out a few weeks ago in May?
Yeah, I think if you look to our Q2 results, a few, I think, highlights. Firstly, very strong order intake. There is very strong demand in healthcare. Our innovations are resonating, and we had a 6% growth on the back of a very strong 9% growth last year. And we also see that momentum actually continuing into the second half, and that's a very strong leading indicator of what's to come. Secondly, we also grew positively, especially also on the back of strong growth in our consumer businesses. So we see also the consumer momentum stepping up. And then thirdly, we saw that our margin expansion in the quarter was 130 basis points, a very strong margin expansion. Combination of, on one hand, our innovations generating more value, but also very strong focus on productivity, on what we can control, and that mix actually allowed us to expand the margin. Now, that first half delivery, which was strong, now taking that into the second half and including the recently announced tariffs, indeed made us upgrade our guidance for the full year by 50 basis points on margin and also an increased cash flow. And that then builds on the momentum that we have in the first half, but also then the recently announced tariffs and our productivity program that we're driving full force to ensure that we can actually take the cost out to mitigate some of the impact that we see.
Roy, 43% of your sales are in the United States. Circa 43% of your sales are in the United States. Is this a good deal? Is 15% a good deal? Is this a number that you can live with?
So this provides certainty. And actually, that's something that we value because we can plan on certainty. That's important for any business. We said at the beginning of the year that actually the most important that we focus on is providing access to patient care and actually innovate behind patient care. And any barriers that are put in that way, of course, we prefer not to be there. And also, therefore, we have been arguing for exemption of the medtech sector out of any trade barriers, because there's already enough pressure on the hospitals, on doctors, on the nurses, and patients already waiting for care as we speak. So that's something that we have been kind of working towards, and that's also where you see the innovation momentum so strongly with the 6% growth in the quarter, more to come in the second half. And at the same time, we also now have the clarity for the second half that allowed us to increase the margin guidance, because we have that visibility on the tariffs as we speak today, including our margin expansion actually that we delivered in the first half and the productivity measures that we took. So therefore, this is something that we can work with towards the second half and focusing on what we want to focus on, patient care. Maybe a great example there was the nationwide access deal to our latest minimally invasive therapies in Indonesia, where we are going to provide a service package towards 280 million people. And that shows that there is a real breakthrough demand for some of the latest leading technologies we have.
Roy, just a bit more on the tariff story. I mean, you're talking there about certainty and about clarity, and we get that from any kind of tariff deal. That 15% rate, though, can you talk us through how this affects any of your decision-making? Are there things you will or won't be doing based on a 15% tariff with the US?
So I think what we are focused on, if you look to the US, and you just mentioned it, it's a very important market for us. It's the biggest healthcare market in the world. We had double-digit order intake growth. We also have strong presence in North America with own innovation manufacturing hubs. And we will keep strengthening North America presence in line with also the demand that we have there, the services that we need to provide to the customers that we see in the US, taking up our innovations, and the consumers that we also serve there. So you see that we are strengthening our presence, strengthening our investments in the US, but also getting the returns by the strong order intake, the sales, and also the margins that we are getting out of that market. That's something that we take into account when we kind of cater for serving that market in the best possible way. The same actually we see also increased momentum in Europe. So actually, I think on a positive note for Europe, we see that also demand here is strengthening. We saw it both on the healthcare side, but also on the consumer side. So consumers are spending more, and we actually had a very good sales growth in Europe. So we're catering to that as well with a good presence in Europe.
Roy, let's look east if we can and talk about China as well. Of course, you have a massive presence there, and we know that you had a double-digit decline in the first quarter. One of the key pieces where we don't have clarity on the trade front is the negotiations between the United States and China, an extension on the table at the moment between those discussions. How does that affect your decision-making at a time when the White House is actively pressing companies to limit their supply chains and limit their presence in that part of the world?
Yeah, I think in China, we already for some years have been working on localization of our supply chain and footprint in China. And actually today we have 90% of what we manufacture and sell in China coming out of China. So actually we have really made sure that we could fulfill the demand in China from China itself. We have also been limiting the exposure from China to the rest of the world, but still there are exports also going from China into other parts of the world because there's also a competitive manufacturing base that you can use. So we made sure that there is a balanced approach where we have a strong footprint in North America, in Europe, but also in Asia, and especially in China, you need to be local for local. But as I mentioned, with the Indonesia deal, there's a big presence now also coming up in Indonesia. So we need to make sure we can fulfill that need as well. We have a big factory in Batam, Indonesia as well. So we're actually fulfilling that also from a local presence perspective.
All right. Roy Jakobs, CEO of Philips, walking us through his take on every region of the world. We thank you so much. He's making a key point there in a guy where he's talking about this idea of regionalization, of localization of production. I'm curious how many people take that his lead.
Yeah, absolutely. Regionalization is something they've talked about for a while. I'm fascinated how you turn around that guidance. We got this trade deal at the weekend, and they've had to do all of this, get ready to speak to the media, speak to investors about the business in just a couple of days.
I spoke to the CFO of Volkswagen. He was like, at this level it costs us this, at this level it costs us this. You do the maths in between.
Sounds
figuring
simple.
it out. Yeah, sounds pretty straightforward, doesn't it? Anyway, more as we work towards the market open. 30 minutes to go until the market opened this Tuesday morning. Is it only Tuesday? Let's talk about where we are in terms of the futures picture going into the equity market open. And as you can see, a little bit of a bounce back. Actually, I think that bounce back has gained a little traction since we started to see some of the corporate numbers coming through onto the screen. Looks like Philips is going to see a very sharp bounce back this morning in terms of its stock. There are others out there as well that are likely to see similar bounces as well. It does look as if we are going to see some quite significant differentiation in terms of how different European companies are handling this tariff story versus their baseline going into the final deal being done.
A little bit of optimism there in the futures picture. Let's see if the optimism shows up in the bond picture as well. 440 on the U.S. 10-year. Not much reaction or read through into Europe right now. We'll see if that shakes out as we get closer to the gilt open in about 30 minutes' time. In the meantime, let's get a quick check on the other markets we have our eye on. Bloomberg's Valerie Titell's here with an eye on the euro.
An eye on the euro, and just what a pummeling session it was for this currency pair yesterday. Many people are suspecting that now we might start seeing economists downgrade their growth forecast for the eurozone. But the move in the currency yesterday, hugely notable because many people are short the dollar. And yesterday's price action is going to start to get people thinking whether this dollar downtrade is done for now or whether that was just a short squeeze. I think the bar is still out on what drove yesterday's price action, but the dollar is headed for the best monthly gain of the year. Its first gain of the year, actually, up 1.5%, really helped by the slide in the euro yesterday. The dollar had its best session in 11 weeks. Do you doubt the dollar's decline here? Is the second half of the year going to be very different from the first half, which saw the biggest dollar declines we've seen in over 2 decades? We did get some clarity on tariffs. That's helping the dollar out. Now it's down to the labor market. Will we get some more clarity with the labor market data coming out this week? It starts with JOLTS data today. We have ADP Wednesday, the normal jobless claims on Thursday, ahead of the non-farm payrolls on Friday. The markets and investors are really wanting to see what kind of clarity we get on the U.S. economy now that we have more clarity on tariffs. But it's helping the equity market out, that's for sure. S&P 500 notched just one record high, but 6 straight in a row, something it's only done a handful of times in the last 25 years. Anna.
Valerie, thank you very much. Valerie Titell with what we're watching on stocks, of course, and indeed all of the movement of the weakness that we've seen in the euro in the last 48 hours or so. We'll watch as that continues. Let us talk about other trade narratives. We've been working our way towards August 1st, of course, because of the reciprocal tariffs, but there is a different deadline also in the calendars for August. U.S. Commerce Secretary Howard Lutnick says that President Trump will decide if Washington and Beijing will extend their trade truce by 90 days. Remember, that runs until August 12th. Howard Lutnick told Fox News more deals are likely with other countries in coming days.
And the president's going to decide, look, this is how I want to play it. He may entertain a few more deals, or he may decide, you know what, I'm just going to set the policy going forward. But by the end of this week, they will all be set. They will all be in stone, and they will be written, and we will start collecting those additional monies. Right now, we're collecting 10% from everybody in the world, and, of course, a higher rate from China. But come next week, off we go.
Let's bring in Bloomberg's Oliver Crook, who is in Stockholm, where China and the United States are talking to each other. Oliver, we've heard these lines then from Howard Lutnick, putting aside the other deals that are being worked on at the moment. But sticking with China and the United States, he certainly thinks that 90 days, another 90-day extension is likely. But what does that mean, really, if we get that? More time to talk about fentanyl or more time to have more substantive talks about trade?
Yeah, it will have to do with a number of different issues that the Trump administration has with China. Remember, this is one of the great cornerstones of the Trump administration in his election campaign, saying that he's going to solve the trade trouble with China, but also a lot of the other issues and the gripes that they have with China. And that is the basis of the conversation that we're having today between the Treasury Secretary Scott Bessent, flanked also by Jameson Greer, the U.S. trade representative, when he is speaking across the table with the Chinese Vice Premier He Lifeng for meetings again in the second day today. So they have not yet arrived this morning. They arrived yesterday. They spent about 5 hours in the Prime Minister of Sweden's offices yesterday having their negotiations. They will pick that back up in the next couple of hours. And what we're going to be watching very closely is, of course, Anna, as you say, do they get that extra runway, that extra 90 days to continue that trade truce, which brought the U.S. tariffs down from 125% down to 30%. Will they extend that for another 90 days to make some progress on some of the other issues that you've just highlighted there, Anna, that they will and work towards towards a comprehensive deal, something closer to what we got between the U.S. and the EU over the last couple of days. But that is obviously something that is a much larger project and one that the U.S. administration really needs to fine-tune, and the Chinese also need to really fine-tune. For both of them, this is really a hill that they're willing to die on, as we discovered in the escalation of the trade war a couple of months ago.
Ollie, what are the key components that we're looking for here? What does the eventual deal look like? What are the kind of the main foundations of it?
Yeah, so when we look at the first Trump administration, there are different sort of varieties and levels of deal. The sort of so-called phase one deal would include things like, from the Chinese side, commitments to buy more U.S. goods, and that is to close the sort of very obvious trade gap, the surplus that China runs with the United States. That would be one component. There is, of course, this other question of new components that could go into such a deal from the Trump 2 administration. Could there be a commitment to buy less oil from Russia, from Iran? This is one of the commitments that the U.S. administration would like to see eventually from China. There is the issue of TikTok, which the United States and Trump has said there is a buyer for in the United States. That still needs sign-off from the Chinese. And there's, of course, the question of fentanyl precursor. So these are all of the sorts of things that will go into discussions around a deal. And, of course, the sort of perennial issues that the United States has brought up, and not just the United States, the Europeans, about IP protections and things like that. From the first Trump administration, you did get some commitments on some of those things, buying more goods, IP protections. The issue is that they're not always, according to the U.S. administrations and other observers, fully followed and abided by the Chinese side.
We'll leave it there. Ollie, thank you very much indeed. You do wonder where they're going to end up next. There's a nice little sort of tour of Europe going on. What have we done? Geneva? We've had London,
yeah.
Now we've got Stockholm.
The common theme is that they all take a long time, these conversations, and go longer than we'd expected.
Yeah,
So there you go.
Nice little tour of Europe going on. Meanwhile, President Trump has fielded more than an hour of questions, this while meeting with the UK Prime Minister Keir Starmer at his Turnberry Golf Resort in Scotland yesterday. Lizzie Burden joins us from there to talk about what that delivered and what the overall tone has been. Lizzie, so what came out of the Keir Starmer meeting? Give us the highlights.
Well, Trump holding court at Turnberry before they got on Air Force One to come here to the west coast to Trump's golf course in Aberdeen. But it very much, Guy, felt like Starmer was stuck in the bunker there for that hour. The president had lots of advice on UK politics, that he should cut taxes, cut immigration, cut crime if he wants to defeat his friend Nigel Farage at the next election. But there was relief for Starmer when it came to Russia, turning the screws on Vladimir Putin, and the president saying that he's cutting that 50-day deadline for a Ukraine peace deal to 10 to 12 days, and we're expecting news on that in the coming days. Also on Gaza, the president for the first time using the word starvation to acknowledge what's happening there, though pretty non-committal otherwise. So what's next here? Well, we're going to wait for the ribbon-cutting ceremony of the new golf course here in Aberdeen, and then it's wheels up for Air Force One this afternoon.
So that's the U.S.-UK relationship in terms of what's on the agenda. Let's talk about what that looks like in terms of the trade dynamics. What can we expect there?
Well, Critty, I mean, the British newspapers this morning are full of criticism of Keir Starmer and sketches talking about how this was another bending of the knee to the president. But if you look at the scores on the doors, being at the front of the queue with Donald Trump secured that trade deal for Britain of 10% tariffs. Brussels, as you know, got 15% tariffs. And Starmer's still looking for a deal on steel, could get 0% tariffs, when Brussels, like the rest of the world, is stuck with 50. So we wait for details there. We're waiting for a potential carve-out on pharma as well. But as you've noted, none of this is on paper when it comes to the US-EU trade deal. Thousands of pages are usually what make up these sorts of trade deals, and then it's got to go to all the EU member states. Implementation could take even longer. But as Valerie was noting, you had a difficult day for the euro yesterday. It's worst against the dollar in over 2 months, and the disappointment reflected across the continent. You heard it from industry leaders. Ultimately, though, the EU trade chief Maroš Šefčovič having to say, this is really the best that we could do.
Lizzie, thank you very much indeed. Lizzie Burden in Aberdeen on the range. We'll come back to these stories as we work our way through the programme. What else do you need to know this Tuesday morning? Let's turn our attention to what has been happening in New York. A gunman has killed at least 4 people and himself in a shooting in New York City, Midtown The attack took place in a Manhattan tower that houses the global headquarters of Blackstone. Staff at the company say they pushed furniture against the door to barricade themselves in during the attack. The gunman was found dead on the 33rd floor of the tower. The rising price of products such as tea and meat has pushed UK food inflation to its highest level in 17 months. The British Retail Consortium said food bills climbed 4% in July compared with a year earlier, the fastest increase since February 2024. The data confirm that a period of falling prices in shops has come to an end, in part due to the government's hike in the minimum wage and higher payroll taxes. And shareholders in Wise have approved a proposal to shift the company's primary listing out of London, a move that will allow the fintech's chief executive to keep his so-called golden shares for many more years. Wise has argued that moving its listing to the United States will ultimately open up its shares to legions of retail and institutional investors, giving it more liquidity and presumably boosting its valuation, Chrissy.
Coming up on the program, a Monday, seeing a surge in inflows as investors turn to Europe. We're going to dive into your stocks to watch just 19 minutes away from the opening trade. Stick with us. This is Bloomberg.
Tuesday morning, good morning. Yesterday felt like a really interesting session. And today, I think we're getting a little bit of a bounce back in stocks. But there's a lot been going on in the last 24 hours, which I think is worth thinking about. Was yesterday the day when the Europe trade died? Was yesterday the day where we thought certainty would be a good thing, but turned out not to be that good because stocks didn't rise that much? I thought certainty would be priced in as being would be something that we could work with, but actually maybe we already knew what this deal was going to look like.
We heard that from Phillips, didn't we? Certainty and predictability, all of those things prized by European business leaders, it would seem, according to that was the Phillips view. I mean, is it a one-day story? Is it a two-day story? Stocks went down yesterday, set to go up today.
But they haven't risen. They
no,
didn't
net
rise
versus
dramatically.
Friday.
There was a period when you got a deal and stocks went up a lot.
Yeah.
And it was kind of risk on. That didn't necessarily feel like
was that because we went up on Thursday and Wednesday, Thursday on the Japan deal and then expectations of the Europe deal? I don't know. Maybe it's sort of, in that sense, was in the price. But also it depends if you're talking about this from an absolute or a relative perspective. If this is relative to previous expectations, that's one conversation. If this is on absolute terms, is this good? You know, that's a different conversation.
Well, it's touching on, I think, one of the fears that are kind of lingering in this market, and that we've gone in 6 months' time to almost parity, all the way up to 117, 118. The risk of a massive swing back in any direction, regardless of what the fundamentals or the technicals of euro-dollar. That's a massive risk that I think a lot of European corporates haven't really hedged for, prepared for, or even talking about, because this consensus weak dollar trade is so prevalent.
The weak dollar trade, because the weak dollar trade wasn't consensus. The weak dollar trade was the surprise in so many ways in the first half of the year. Does that unwind in the second half of the year? Steve Barrett's got a note out talking about the fact that maybe actually the strength in the euro was just rebalancing, that actually people were too overweight the US. But with the deal that's in place now, do we go back to being more overweight the US, that AI trade, that kind of a narrative that works? Is that something that people go back to investing in?
But it's also the speed of the move, right?
Yes.
And right now, if we see this kind of move that we saw in the last 24 hours, now every single day moving forward, that's a problem. If it's a one day, as Anna was suggesting, then it's perhaps not as scary.
Yes, and lots of corporates will tell you, you know, we can't run our business managing for FX because we don't control that. But they will be hoping, to your point, Critty, that these things don't happen too quickly, because that is something that can give them headaches. Let's think about FX and what that tells us about the market's verdict on the trade deal. Morwenna Coniam joins us, who leads our UK markets coverage. But here with 3 minutes on the markets for us. Morwenna, good morning to you.
Morning.
Let's talk about the euro then. We saw euro weakness yesterday, a real feature. Once again today, down 0.2%, 115.62 is where we trade. I mean, this was a currency that had been at a 3-year high coming into this agreement. So what can we tell from this euro weakness?
Right, absolutely. I think the context is really important. It had seen its biggest rally since for the start of the year, since 2003. You know, it's a really huge gain that we've seen in the euro, and a lot of that has been about dollar weakness. We've seen the same with the pounds ascent. So this dollar story, which you guys have just been discussing, I think is crucial to actually how the euro, people have been positioning for that. And then there's been so much anticipation of this trade deal. There's been, you know, a lot of concern, I think, about whether it was going to be reached before the deadline, you know, what was going to be in it. When, in fact, when it was first announced, you saw a bit of a relief rally. And then you had that realization set in, that moment of actually, wait a sec, this is still going to be more expensive for a lot of companies, than it has been before. 15% is a lot more than the 1% that, was kind of expected previously. And it wasn't as bad as it could have been, but it was still worse than the status quo. And that's the same thing that we saw actually when the UK trade deal was announced. Actually, there was a bit of a relief, and then people saying, well, this is still more than people have paid. But when you look at, say, the autos deal that's been agreed, actually, perhaps it's not nearly as bad as then the market has actually been thinking. So I don't know whether the reaction perhaps has been a bit overdone. There's a lot of sort of pent-up anticipation for this. And people are really just trying to figure out, look, is this good for Europe, or is it bad for Europe, or is it worse for the US?
Back to that relative and absolute conversation.
Yeah, and I think we're not going to know until probably the end of the year in terms of the effect that it's going to have. It's only Tuesday. The week is just getting started here. We've had a massive amount of news already. The Fed's going to be sitting down. We're getting into some key central bank meetings. Is this going to be the next catalyst that could change the narrative that we've just been discussing?
Yeah, I think it is really crucial what we see this week. Obviously, we've got the Fed, which is expected to keep things on hold, but really people are starting to position as what's coming in September from them. We've also got some crucial US data. We've got inflation, we've got jobs, and I think that's going to be important for how people look at, well, look, how is the US economy doing? Are these tariffs actually starting to make an impact on how companies are making their decisions? And if that is impacting things, that also going back to what it says about the current exchange rates that we're seeing and the reaction. But we've also, got to look at what's coming up for countries elsewhere. We've actually got some EU GDP data coming through this week. And, it's also, we've got the Bank of England decision next week. And so that's being sort of priced into the pound, which is acting as almost a bit of a pivot point, I think, for the euro. It fell yesterday. It's actually, back below $1.34, which is, quite low for the pound, considering it recently went up as high as $1.38. But when you think about it, that in context is still quite high. And actually yesterday it was the best performing G10 currency. So actually are people just sort of going, OK, well, we'll just sort of move away from this because we're going with this strong dollar narrative. And again, it's all about the dollar. It's not really about the individual
that's a tone shift,
Marry all that macro into what we can expect in earnings this week.
Well, exactly. I think also crucial for how people view the US story is going to be this week's earnings. We've got 4 of the Magnificent 7 reporting. So much anticipation. Signs are that there's going to be more growth there. We've seen the S&P, rising, and actually the whole earnings season so far. We've seen about, I think, 80% of companies announcing, profit beats, and that's something we're seeing also in, Europe and in the UK. Barclays this morning, we've seen really strong results from the banks. So things are actually looking pretty sort of bullish on the equity side. I think how this week's big tech earnings come out will be really crucial. And actually whether the market has been looking so much at those, actually some of the value stocks are actually starting to outperform. And I thought it was really interesting looking at the year-to-date performance. We're actually seeing the FTSE 100, outperforming both in terms of returns, both the Stock 600 and the S&P. And why do people like the FTSE 100 often? It's about value. So whether I think how these results come out this week will be really crucial for how people view the sort of equity story going forwards and actually how vulnerable is the S&P rally.
Something we're going to be keeping a close eye on. Rowena Coniam there walking us through what we can expect in the days ahead. We thank you so much. You get more update analysis from her and the team. MLIV Go is the function on your terminal. Let's get our stocks watched now with Chloe Melly. Chloe.
Good morning, Kriti. Let's start with Barclays. So really strong results from Barclays this morning. The investment banking revenue beat estimates by quite a large margin. That was driven by really good performance in fixed income and also equities. That's, of course, due to the market volatility that we saw in the second quarter. That's something that Deutsche Bank has mentioned, something that BNP has mentioned before, and that's also benefiting Barclays. It also has announced a buyback of up to £1 billion, which is ahead of the $750 million that it had announced last year. So it should kind of extend the gains that we've seen over the last few months. The year-to-date share price is up almost 35%. So we should see an extension of that this morning at the open. moving on to Philips. So Philips, we've got an interesting kind of reversal of narrative from Philips. So it raises profitability outlook, and that's just a couple of months after it actually had cut it. So it said in May that it was due to the trade war, it was cutting its guidance. And then today it said, well, you know, the tariff impact was actually not as bad as we originally feared. So we might see some relief in the shares this morning. It is down almost 19% over the last 12 months. So we might see a little bit of a boost coming off that guidance raise. And then finally, Amundi, French asset manager, it's also kind of shaking off and brushing off that tariff impact. So it reported inflows that's compared to expectations of outflows for the second quarter. The CEO said that was really due to kind of customers repatriating those flows to Europe and moving away from the US. The analysts are already kind of enthusiastic about the stock. We have 13 buys, 0 sells. So we might see that kind of investor enthusiasm going even higher this morning on the back of that for Amundi.
Chloe, thank you very much. Our equities reporter, Chloe Melly, with a look at some of the stocks that could be on the move. I'll throw in another one, Sika, Swiss construction. Never far from my mind. I like this story because this is how everything wants to be a tech stock these days. So they sell. This is a construction business, but they are talking about more than 1,000 data centers were built using their technologies. They're the preferred partner of technology, which seems to be the line that they're selling this morning. Might not help the stocks though, because some of the numbers looked a little bit light.
What is the AI trade back? It never went away, and clearly it has been driving things. But is it the only one left standing at the moment in terms of the overall narrative? This morning's going to be about the relative positioning on the trade front, but I don't know whether or not Europe still has the momentum. Where is the momentum going to be in Europe from here? Banks have massively outperformed. Does that continue? Can it continue if the macro backdrop starts to fade a little bit? I don't know. It feels like yesterday was a really pivotal day, and I can't quite work out whether
and we still don't know who'll pay for these tariffs, do we, essentially? That's it for the opening trade's first hour. Futures pointing upwards. We'll be back with the market open shortly. This is Bloomberg.
Yesterday was a really interesting session. Stocks didn't go up on the certainty of a trade deal. The fact that we had a deal done and we knew vaguely what that deal looked like, which I think was really interesting. Is the value of the certainty, therefore, less in this deal, the Europe deal, than the reality of the deal? And I think that was maybe what got priced in yesterday in terms of the equity market story. Look, Europe rolled over. Europe definitely rolled over. The euro rolled over quite sharply yesterday as well. The US bounced a little bit towards the back end of the day, but there's still a long way to go this week. Remember, we've got the Fed, got all kinds of data that we need to price in, jolts a little bit later on. So we're not done yet, but I thought Monday's session was really interesting in terms of the setup for the whole week. Kriti, what are we seeing in futures?
Well, a little bit of a turnaround Tuesday, what shows up into futures picture. Your Stoxx 50 futures higher by 0.4%, but your laggard this morning is right here in the FTSE 100, right here in the UK, down higher only by 0.2%, in line with what you're seeing in the likes of S&P futures, for example. But the outperformer, going right back to routine, Anna, is the DAX.
Right, yes, and maybe making up for some of that underperformance of yesterday. Let us see. Let's talk about some of the individual stocks that could be on the move. We've had lots of corporate reporting from some fairly big heavyweights across Europe. Barclays, with its numbers out this morning, the UK bank, planning a £1 billion buyback. Traders really lifting the earnings story. So this is equities and FIC trading all coming in better than had been anticipated. Philips in the medical technology space, increasing the profitability outlook. It's not going to hurt them. They're not going to take as much of a hit as they thought back in May. Things have changed. The thinking has changed by around 100 million euros. So that's a positive for Philips. And Stellantis in focus, expecting to take around 1.2 billion euros hit from tariffs in the second half of this year, Guy.
Yeah, what is the tariff hit? That's what effectively is being priced in this morning. OK, here we go. Market open this Tuesday morning. Yesterday was fascinating. What are we going to get today? Initially, we are expecting some kind of a pop to come through broadly across Europe. Keep an eye on what's happening in the currency markets. Keep an eye on what is happening in the fixed income trade as well, because it's all kind of fitting together in a really interesting pattern right now. But the FTSE 100 struggling to gain some headway as we speak. The Stoxx 600 is up by 0.1%. The DAX is barely budging to the upside as well. This on the back of, what was it, negative day yesterday. This doesn't feel like it's a a kind of reassessment of the situation. This doesn't feel like we are taking a different view of what that trade deal is ultimately going to look like. The DAX is up a little bit more, got battered yesterday. The auto sector is going to be interesting. What's happening in banks right now is interesting as well. The FTSE's got Barclays in the mix too. But the DAX acted quite quickly this morning in terms of its numbers, which means it doesn't feel like there's a narrative shift, maybe just in terms of the timing of how quickly things have changed. We'll wait and see what happens with the CAC. We're going to get some luxury names a little later on today, which is going to be interesting as well. But at the moment, we are a little higher in Europe. This doesn't feel like a particularly convincing turnaround. Critty, sectors.
It does feel like a little bit of a, maybe not turnaround from an index perspective, but certainly a bit of a rotation when we're looking at it from a sector perspective as well, because yesterday's losers are today's winners. And right off the bat, I'm looking at the pharmaceuticals. I'm looking at some of the defense names. Those were two places where we did see a little bit of weakness and kind of lagging the broader risk-on sentiment, at least where we started in yesterday's trade, at least 24 hours ago. So this, I think, is really crucial here, that some of your biggest decliners are actually going to be, besides Novo Nordisk, we'll put that to the side, but some of your luxury names, a lot of the French market taking a hit. But to me, what immediately catches my eye is the pain we're seeing in some of these earnings stories. Stellantis, for example, down 2%, almost 2%, and falling on those earnings numbers.
Yeah, interesting to see how we're getting this, this granularity, this reassessment from each of the businesses. What had you previously assumed? What do we know now? What does that mean for your previous assumptions? And in the case of Stellantis, they've had to take another hit. It's interesting because I got this Auto's note from UBS earlier saying Stellantis it's not really about the transatlantic trade for Stellantis. That's not where the area, the damage is being done. It's more about their US businesses and the North American trade conversation. And that's something we're focused on. But that's not the only corporate earnings story we've had out this morning, although Stellantis is, as you say, Critty, one of the early fallers, so down by 2.8% or so. Philips, that one's halted, so we don't know where that one is. But there is the other side of the narrative, perhaps, where they previously had made some pretty aggressive negative assumptions about what this was going to do, and that things look a little brighter now, net, and so they're able to upgrade their guidance. So it's halted now in Amsterdam, but Philips, when it opens, might be something that bounces this morning.
Amundi's down really sharply. Which the headline certainly first thing this morning, Amundi Post surprise inflow in Europe's biggest as Europeans bring home funds. That's not being rewarded in the way that you would have anticipated. So we'll come back to that one and figure out what is happening there. Inchcape in the UK down really sharply. I'm not seeing a clear kind of narrative evolving here in terms of kind of winners and losers. It's reasonably balanced. There's 339 up, 220 odd down. So it's a reasonably balanced market from a breadth point of view. There are some clear sort of single stock stories. But what I'm not seeing here is a market that is bouncing back sharply after kind of what happened yesterday. This doesn't feel like there's been a change in narrative. This is a tough deal for Europe. This is a tough deal for Europe's corporates. And there's been no obvious reassessment of that in the market this morning. Euro-dollar is still kind of under a little bit of pressure. That's still the overriding narrative, and that hasn't changed. 115 handle on Euro-dollar.
I wonder if moving forward, resilience is the key kind of in terms of gaining. And I think AstraZeneca is a great case study for that, because you see those markets higher, or that stock, higher by about 0.8% this morning. Despite those earnings not beating by a massive margin, they were just showing that they can keep things as it is, and that is enough.
Pharma looks like the big winner out of this.
Yeah.
There was an expectation, and we talked about this yesterday, there was an expectation that maybe Pharma would get
a bigger hit.
A much bigger hit.
Yeah.
And that has not turned out to be the case.
Still planning some sectoral tariffs. I know that won't apply on every geography, but he's still planning. He said just last night, I think, that tariffs on pharma will be coming soon. So we'll wait and see what that means for the wider sector.
Let's see how that shows up and how you trade these markets. We've got the perfect guest for that. Maria Minucci, fund manager at M&G Investments, joins us around the table this morning. Maria, I'll put that question to you. How do you trade these markets? What's that next catalyst in terms of interpreting what trade means for European corporates?
Well, I think what we're observing right now is the market really trying to come to terms with this latest piece of information. The truth is that we will not know for quite some time, not only what the details around this trade deal are, but also how the different players will be affected from this. Are the exporter going to get hit more on selling price and volumes? Are the importer going to get squeezed on the margins? Or is actually the final consumer that is going to bear most of the costs of these through increase in prices? So it's still very much to see how the impact of this new tariff will play out on the economy. And unfortunately, it's not that immediate. I think there is, like for monetary policy for some extent, a sort of long and variable lags on how the impact of tariffs can be then expressed in the economics of it. However, what we are observing is that from a market perspective, there is potentially a bit of a crisis fatigue. So we have been a few years into an environment where we have been crying wolves quite a few times, first with interest rates, then with geopolitics, now with tariffs war. But the market has become a little bit desensitized from these worries and has been focusing more on the actual earnings delivery, and that has been, so far pretty good, and that has led, risk assets to continue to perform pretty well until now. However, it's important to be cautious at this time and being fully aware of what these developments might bring over the medium to long term.
It's a fascinating one as well. And Maria, just one quick moment while I mentioned the Phillips move. It is officially trading now higher by 13, almost 14% this morning. They, of course, have lifted their profitability outlook. A lot of that coming on that clarity. And that's a conversation we had with the CEO, Roy Jakobs, in the last hour as well. But Maria, that brings back the question of clarity, of resilience. These words that we're hearing from the leadership of really corporates around the world. Do you really feel like we have clarity? Does 15% offer that clarity when perhaps, as Anna mentioned, we have sectoral tariffs coming down the pike. We have geopolitical volatility still very much in the mix. Is 15% clarity?
I think there is no clarity at the moment, not on the specific 15% for Europe versus US, but also in general on the tariff deals that we're seeing across the globe. There is still a lot to be worked out. And as I said, not just on the characteristic of the trade deals, but also on how these then will affect the broader economy. It's really very much wait and see. And I think this is where we're seeing central banks at the moment as well. They're very much waiting for the dust to settle and trying to understand what the effect will be on macro data in order to then adjust the monetary policy response to that.
And you talk about crisis fatigue, Maria, which we can all see in markets, and yet, and that crisis fatigue means that we keep hitting records on US stocks. Is that something that ends? Are there any cracks? I mean, maybe credit markets. Do they tell us anything interesting about where cracks might appear?
Indeed. So I think you can see that quite clearly on risk appetite, which remains elevated. You're seeing in flows in US markets, you see equity market reaching all-time high. You're seeing it in credit spreads. As you mentioned, credit market trading at very tight spreads on a long-term period and continue to deliver good returns other than, the volatility phase that we've seen in April. And also another interesting indicator is the equity risk premium that we're seeing across markets, really. And that really tells us that there is risk appetite present in the market, that risk aversion is not really featuring very strongly. And another feature of that or characteristic of it is how investors are thinking about government bonds. First of all, there is the behavior of government bonds that has not been particularly satisfactory and has continued to be volatile. But there is a real, distaste for government bonds as a source of diversification, even potential diversification over the medium to long term.
Yeah, and with what we've learned about tariffs this week, are you still happy with an underweight approach to US stocks and an overweight approach to Europe? Guys asking this morning about whether anything has changed in our thinking around Europe and the Europe trade, which has been so strong in recent months. But then we get this trade deal and markets aren't sure it's all brilliant. So does anything change in your thinking, or are you happy with that overweight and underweight positioning?
Well, I think the overweight Europe and underweight US has served us very well from the beginning of the year. We were getting some very strong signal at the end of last year on this divergence in terms of valuation and sentiment. However, we have come quite a long way now. And although we remain relatively neutrally positioned in equity markets, we're very keen on exploiting some of the opportunities that exist within different regional and sectorial markets within equities. And in particular, we are looking for opportunities in cheaper, more idiosyncratic and diversified markets. Europe has been one of these. I think now the opportunities might lie a little bit more in emerging markets, Asia, Japan, which are areas that we are looking at quite closely from an equity perspective and where we still see quite a lot of opportunities. For example, recently we have been switching a little bit of our UK equity exposure after a strong performance into Japanese equities just before the trade deal was agreed.
To a past peak Europe, is
Well, I think over the medium to long term, you still have opportunities in Europe because the valuation is still relatively on your side relatively to other markets. You have the potential of fiscal spending coming from Germany, which is seen as a positive. But potentially in the short term, you are seeing some slightly less appealing opportunities because not only of the trade deal that we're seeing now, but because the market has been performing pretty well. You are seeing valuations that are not expensive, but relatively to its own short-term history are relatively.
But if I see more opportunities in emerging markets, do I take money out of my US bucket to put into those emerging market opportunities, or do I take money out of my Europe bucket to put in to those US opportunities?
That is your starting point, considering that we are starting from a very, very underweight US equities. Probably European equities where we have been overweight will be the place where to look. But if you are running very overweight US equities, I still think that as an overall market, you are seeing some high valuations. There are pockets of opportunities. There are some very strong growth area in the US. But overall, when you apply a tariff to US importer, potentially this is where you have to look for most of the damage to be done. But as I said, this remains to be seen in the coming weeks and months.
We will watch
something to keep an eye on.
Tune in. We'll be talking about it every morning. Maria, nice to see you. Thank you very much indeed. Maria Manucci, fund manager at M&G Investments, joining us on where we stand post this trade deal. Let's take a look at the Core 6 this morning, figure out exactly what is happening at the centre of gravity of Europe. As you can see, plenty of stocks still in negative territory. Look, we're going to start to get luxury names out a little later on today. Kering's going to be posted numbers. LVMH is down by 1.25% this morning. Pharma's weakening up as well. Novo's a little softer, but we do have numbers out from Astra. ASML is up. Schneider is up. The tech trade still works, believe you me. And you can certainly see that this morning in a number of different businesses. But Nestle's softer. Look at that. The food story is coming down as well. But we are thick into the earnings season now. There's plenty of moves that we need to be watching. Chloe Melly is here with some details.
Good morning, Guy. Let's start with really good news from Philips this morning over in the Netherlands. We are up 10.5%. So Philips raised its profitability outlook after cutting it just a couple of months ago in May. It said that now it considers that the tariff impact really is not as bad as it originally feared, and it raised its outlook as a result. And we are up almost 11% this morning off the back of that. Moving on to Amundi, the French asset manager. So I had expected this to go a little bit differently for Amundi. It had reported net inflows compared to expectations of outflows. But crucially, this morning it is down. It is down almost 5%. It might be on the back of adjusted net income that actually missed expectations. So it's not getting rewarded for those net inflows, but is instead taking a little bit of a beating off the back of that miss. Moving on, we have got EssilorLuxottica, which is the world's biggest eyewear maker. The shares are up 5.2% this morning. It reported better than expected sales. That's thanks to really strong results in Europe and also really strong sales of its smart glasses. That's a segment that it has been really focusing on, and it seems to be rewarded for that. And then finally, let's end on Stellantis. So Stellantis is expecting a 1.2 billion euro hit from tariffs in the second half. It is down 2.8% this morning. It had obviously reported its preliminary earnings last week, and now the full set of earnings is not reassuring investors much. So we are down 2.8% this morning off the back of that.
Chloe, thank you very much. Chloe Melly from our equities team. Thank you very much. It's not a very convincing picture in either direction, is it, today? There's a sector breakdown, 50-50, stocks going, sectors going higher, sectors going lower. And maybe that speaks to the point that Maria was telling us earlier, that it's going to take quite a long time to work out, well, firstly, the details of this trade deal across the Atlantic. We don't have any of those details. You work those out, you get them approved, and then businesses can see what this is really going to do and decide where this hits on their margins, pricing to consumers. We just don't know yet.
But yes, I hear what you're saying, but actually some companies are coming through and being quite granular in quantifying what they think the story is going to be. Philips is one of them. Volkswagen did it on Friday, really quite clear in terms of the narrative. Stellantis is out with some quite specific guidance this morning in terms of the hit that it feels it's going to be taking as well. Some companies, they've done the maths. And I remember sitting down and having dinner with the CFO at Airbus, and he was like, yeah, I can quantify everything in terms of the trade impacts. I can tell you contract by contract kind of what the drop-down is and how it all feeds through. So I think some companies do have maybe some granularity that they can work with quite quickly in terms of understanding and therefore updating investors on it. I think the macro picture, I think at a sort of bottom-up corporate by corporate story, maybe you could do it quite quickly. I think at the macro level, I think it could be harder.
But I think the point of the granularity comes more in the industrial base. If you're a company like SAP, for example, can you do that math as easily when more of it is driven by the consumer story rather than your supply chain?
Secondary effects, right?
Yeah,
if you're a services business, yeah.
Exactly.
So I think the services which haven't been more directly affected, I think if you're in a manufacturing company, you probably know input cost this, output cost this. This is kind of we can do the maths on this quite easily. I say easily. I'm sure there's some pretty complicated models out there, but nevertheless, they probably know at this point what the hit is likely to look like.
OK, talking of one of the companies that has given us some of that granularity today, Stellantis stalls. The car maker sees a €1.2 billion hit from tariffs in the second half of this year. More details next. This is Bloomberg.
Broadly, M&A will increase as there is more stability in the macro environment. Of course, each company, each bank, each situation is very different. But I think there are rewards to scale. I think those rewards to scale will be realized. We are happy to have many, many businesses at scale, and we know how important it is to protect and to grow that scale. And new technology will only facilitate that and, in fact, increase the returns to scale. So I think that's what companies will be looking at.
That was the Barclays CEO, CS Venkatakrishnan. Venkat speaking to us a little earlier after the company reported second quarter results this morning. We got the results from Barclays, we got a buyback from Barclays, and the stock up by 0.1% this morning. Let us bring in Bloomberg Sam Unsted, though, who has found plenty of detail to get excited about, more detail perhaps than the stock has got excited about this morning. Sure. But the investment banking side of things, the revenues on FIC trading and equities trading, all of that coming in better than anticipated, Sam.
Yeah, really good. I mean, there's much better than expected. I think, though, that you've got a clear situation where it's been priced in already. You know, already the US investment banks are very strong, the European investment banks as well. So I think that side of the story has already been priced. The share buyback is positive, no question. You know, that is sort of the main piece of attention I think they'll get today. But on the other side of that, the two-pronged kind of strategy at Barclays is also in the UK, and they've been doubling down on the UK in the last couple of years, and the trends there not quite so strong. So the income there, the lending income, the lending margins, not quite as good, and certainly didn't look quite as good as you saw from particularly NatWest and also from Lloyds.
Yeah, because that's interesting, following on from Lloyds and NatWest and the strength we saw there.
Talk to us a little bit about Wise this morning. What should our global audience know there?
Wise, so with Wise, this company is one of the many, unfortunately, that has decided to leave the UK, moving their listing across the pond. There was a bit of controversy over it. There were some shareholders pushing back against Wise doing this. They have got it through. It has been passed through. It's quite an interesting one for the London market because Wise, unlike, say, Flutter, for example, that did a similar thing, Ashtead, which is doing a similar thing, doesn't make most of its money in the US. So they are really doing this almost purely from a valuation perspective. So this going through, particularly with the fintech, you know, from a London market that's struggling to keep any kind of tech, fin or not, it is not a good sign. However, there is a potential listing as well. This morning, Shawbrook, which was listed here previously, is lining up more and more banks. That does look like it will now happen in the second half of this year. Not big enough to replace Wise, and the narrative remains quite negative for the London market. But, overall, a minor positive.
So, the joke, is it a wise move? Have all these things that have gone to the States generally worked? Is this something that you can kind of bank on?
So this is going to be an interesting test of that because, so let's take Flutter, for example. Flutter, they own Paddy Power for years and years, most of their money coming from the UK. As the US gambling market has opened up, that is now their major growth driver. Yeah. Their comparable valuation is clearly against something like DraftKings, which they were trading at a discount to previously. That has worked for them, so they are doing very well. Wise have got certainly comparable companies over there, but they don't make most of their money in the US. You know, that's still not their key market. May well be their key growth market in a few years' time, but at the moment it's not. So this will be an interesting test of whether that just pure valuation story actually works for a company changing its listing.
Yeah, the biggest irony of all of this is the London Stock Exchange to me, the London Stock Exchange Group, whose biggest comparables are over in the States. You wonder whether it would trade on a slightly
good question.
Better multiple if it listed over in the States with all its data management businesses. Sam, great stuff. Thank you very much indeed. Just worth noting that the euro is being pushed lower, has been pushed lower over the last 20 minutes or so, down towards to bottom of the session. Let's talk a little bit about what is happening in the car sector this morning. So we've seen a number of car makers reporting numbers over the last few days. We've still got more to come. Stellantis is the name that we're focusing on this morning. It's basically saying this morning it expects to take around a €1 billion, 1.2 billion euro hit from the tariffs. That's going to come in the second half of the year. Bloomberg's Global Autos editor Craig Trudell joining us around the table. It's quite a bleak outlook from Stellantis. Is it all down to tariffs?
I think tariffs are certainly not helping, and that level of impact in the second half, I mean, that's roughly 3 times what hit them in the first half. This is a company that pre-release last week said roughly 300 million euro impact of tariffs. But a lot of this is also self-inflicted, and that is evidenced by the fact that we do have a new CEO of this company who's taking over, having to make some difficult decisions of how do you rationalize this company that ironically both had an issue of its previous CEO maybe cutting too deep in certain respects, and yet it's also probably a manufacturer that needs to rationalize even more. It probably has too many plants, too many brands. And Antonio Filosa is going to need to make some difficult decisions in the coming months.
It has a lot of brands, doesn't it, Craig? Yes. Many, in many parts of the world. And actually, I was reading a note from UBS this morning talking about how, in terms of what's really important to Stellantis, it isn't necessarily the transatlantic deal, because they don't send that many. They have lots of brands on both sides of the Atlantic, but they don't really cross over very much. But then it's the North American trade agreements and what happens with Canada and crucially with Mexico, and that is the real area of pressure for this business.
That's the hugely important one where, it was taken as a given for decades that, when the U.S. calculated domestic content in the auto industry, they counted cars and parts made in Canada as domestic. And that is decidedly not the case anymore under the second, Trump administration, where, now the plant where they make minivans in Windsor, for example. What do you do with that factory when suddenly the tariff impact of trying to send those over the border is so substantial, but also manufacturing down in Mexico, and is there some ability for them to make some adjustments to scale up some of the plants that they do have in the U.S.? I think they are positioned in maybe to an advantage to some manufacturers where they have some slack in the system in the U.S. that they can flex up. But that's going to take some time and require some investment and some costs. And it's not going to be cheap for anybody. I think that's the short of it for this industry, that this is going to be very costly.
OK, thank you very much. Thanks to Craig. Bloomberg's Global Autos editor Craig Trudell with the latest on Stellantis, just one of the businesses that has been telling us about the tariff impact this morning. That stock down by 4%. We saw weakness in the auto space yesterday, and Stellantis continues to show us some weakness after some positivity of last week, of course, for the sector. Coming up on the programme, we're back out to Aberdeen, where Donald Trump continues his very eventful trip to the UK. He was being asked, of course, as is the norm in these gatherings with media, about a host of subjects yesterday, and so he addressed them. We've got a live image coming to us from Aberdeen, from the course that President Trump has been opening up there. We will talk perhaps less about golf and more about the global political agenda, though, when we come back. This is Bloomberg.
We're 30 minutes of the equity market session. Generally, equities are bouncing back a little bit today. I have to say the euro's not, though, which I think is interesting. There's some single stock names which are certainly driving stocks higher in Europe, which is certainly helping the overall narrative. Philips is one that really stands out. But the euro is near session lows. About half an hour ago, it took a big hit lower and has basically stayed there. And you do wonder whether or not we hang on to 115 today, Critty, in terms of the overall performance that we are seeing.
I think the currency component is so crucial in terms of correlation you're starting to see with the tick-by-tick index moves as well. That's starting to show up in a way that I feel like I haven't seen for a couple of months there.
Yeah, with industrials and goods, and industrials as the best performing sector, these are companies that might benefit from a euro that isn't quite so punchy as it has been.
Yeah, and we'll see if that swing back actually benefits it. All of it really comes down to, of course, the trade deal, though, and not just a trade deal in terms of the United States and Europe, but of course, the United States and China as well. U.S. Commerce Secretary Howard Lutnick saying President Trump will decide if Washington and Beijing will extend their trade truce by 90 days. Now, Lutnick told Fox News more deals are likely with other countries in coming days.
And the president's going to decide, look, this is how I want to play it. He may entertain a few more deals, or he may decide, you know what, I'm just going to set the policy going forward. But by the end of this week, they will all be set, they will all be in stone, and they will be written, and we will start collecting those additional monies. Right now, we're collecting 10% from everybody in the world, and, of course, a higher rate from China. But come next week, off we go.
Let's bring in Bloomberg's Oliver Crook, who, of course, is on the ground for us in Stockholm. Ollie, just walk us through what we know here. It feels like an extension, at least 24 hours ago, was the best case scenario out of these talks. Is that still true?
Yeah, the prize here for U.S. representatives and Chinese representatives having discussions in the building behind me, which is the Swedish Prime Minister's office, is an extension, a 90-day extension of that truce between China and the United States that saw tariffs between the United States and China come down from 125% down to 30%. That is supposed to expire on August the 12th. That is what these people are here to discuss over the next day in order to try to get more runway to have a more broad and more meaningful conversation about the trade arrangement between the two biggest economies in the world going forward. So we are still awaiting now Scott Bessent, the U.S. Secretary, Treasury Secretary, and Mr. Greer, the U.S. Trade Representative, who have not yet arrived yet. The Chinese delegation that is led by the Chinese Vice Premier has also not yet arrived. We understand the U.S. delegation is currently having a breakfast with the Swedish Prime Minister, having a bilateral meeting there. But that's where these conversations are going to go for the rest of this day. What we hope to get is potentially a press conference, a briefing from the United States and China. We'd like to hear kind of the outcomes of these talks. But the prize here today, in terms of what the step forward will be concretely, will be an extension of that truce for another 90 days in order to create more runway to have more meaningful discussions about what the trade arrangement looks like in the future.
Where does this all go, though, Ollie? Is the status quo as we have it at the moment actually good enough, and just pushing the story down the road a little bit further is enough? Is that really actually what we should expect now going forward? Just extension after extension after extension. Why actually do we need to get a deal here if the extensions keep working?
Well, we know how Trump tries to sort of run the politics within the United States and his administration. It's a very sort of impressionistic, a bit sort of improvisational. So there may come a time in the future where it will serve the interests of the United States to have a big win in a trade arrangement with China. They've got these sort of wins over the last couple of days with other trading partners, including the European Union. So potentially there is not a great deal of urgency to do that right now. What the Trump administration would like to see, however, is a rebalancing of the trade arrangement with China. That would mean that they would like to see the Chinese committing to buying more American goods, potentially in agriculture. That is something that would be a phase one part of a deal. That is something that we saw in the first Trump administration. There is, of course, the issue of fentanyl precursors. This is something that the Trump administration has talked a lot about in the past, but there are also a number of other issues. There is the sale of TikTok, which the Chinese still need to okay. The Trump administration says that there is a buyer in the United States. And of course, there are these sort of small areas in which they are completely dependent on one another, China and the United States. That is rare earth metal refinement and those rare earth magnets, and of course those advanced AI chips. So there is a need to work together to a certain point. Do they need to go all the way to strike that trade deal? I think the difficulty here, Guy, and that you will see between China and the United States, is that the European Union, for example, is willing to indulge Trump, is willing to sort of bow to some of the theater. The Chinese are not willing to do that. That is what we saw in the trade war that went on a couple of months ago, where we saw tariffs ratchet up to 125%. The Chinese for decades have been sort of cementing their status on the global stage politically and economically, and they are not going to go for a pragmatic theatrical bow in order to appease the Trump administration, which is why these conversations are going to be a lot more difficult to crack.
Yeah, it's interesting. I've seen a few people making the link between the Europeans' reliance on the United States to provide defence and the willingness of Europe to accept what was on the table from the Trump administration, or at least to take some of it. So interesting to make that comparison then with China, and things look very different. Oliver, thank you very much. Bloomberg's Oliver Crook with the latest on the China-US conversation. Meanwhile, President Trump says the United States would work on a new effort to provide food aid to alleviate starvation in Gaza, along with other governments and organisations, including the UK and the European Union. Trump laid out his proposal during a meeting with UK Prime Minister Keir Starmer at his golf club in Turnberry in Scotland.
Hamas has become very difficult to deal with in the last couple of days. I'm speaking to Bibi Netanyahu, and we are coming up with various plans. We're going to say it's a very difficult situation.
President Trump is today at his new golf course in Aberdeen, which is where our UK correspondent Lizzie Burden is now, following Trump from Turnberry to Aberdeen then, Lizzie. So what else came out of President Trump's meetings with Keir Starmer this week, and what's on the agenda for today?
Well, the two leaders flew from Turnberry to Aberdeen on Air Force One last night, and we're going to be hearing from the President in just about an hour and a half's time when he opens this new course. But that meeting went on for about an hour, the press conference. Pretty painful at times for the Prime Minister. The President having lots of advice when it comes to UK politics, that Starmer needs to cut taxes, cut immigration, cut crime, if he wants to defeat Nigel Farage, his friend, of course, at the next election, because of course Farage's Reform Party has been leading the polls here in the UK. But there was relief for Starmer in terms of Trump praising his leadership, and of course that warm relationship is what put the UK at the front of the queue when it came to the UK's trade deal. Also, as you mentioned, on Gaza, the President for the first time acknowledging the starvation that is happening there. We're going to have an emergency cabinet meeting in the UK on Keir Starmer's intervention there. And then when it came to Russia, relief perhaps that the President is willing to turn the screws on Vladimir Putin, saying that 50-day ceasefire, 50-day deadline for a Ukraine peace plan needs to be now 10 to 12 days, and we're expecting news on that in the next day.
Lizzie, what else is on the docket here? When it comes to the trade conversation, what else needs to be resolved?
Well, for Keir Starmer, of course, there's plenty when it comes to tariffs that he still wants to get resolved. Yes, he managed to get a 10% deal compared to Brussels' 15%. It would be even more of a victory if he manages to swing 0% tariffs when it comes to steel, when Brussels has got 50%. He also wants a carve-out when it comes to pharma, a huge question mark when it comes to pharma levies. And indeed, we're going to see that sectoral picture play out. When it comes to the Brussels deal, we are still waiting for anything to be on paper. As you know, it takes a long time to get thousands of pages of trade deals put together, and so we await those details. But the disappointment in what Ursula von der Leyen was able to achieve, just creeping through yesterday, leaking out from industry leaders to individual countries across the EU. Should they have retaliated harder is the question. Back in April, just as you saw from Canada and China when it was initially Liberation Day.
Lizzie, thank you very much indeed. Lizzie Burden joining us from Scotland as we wrap up the Trump trip to Scotland. Obviously, he's heading back a little bit later on to the United States. We'll carry on the conversation, figure out exactly what this all means for markets. I'll tell you one thing it means this morning, a weaker euro. The euro now trading 115.36. This is Bloomberg.
This provides certainty, and actually that's something that we value because we can plan on certainty. That's important for any business. We said at the beginning of the year that actually the most important that we focus on is providing access to patient care and actually innovate behind patient care. And any barriers that are put in that way, of course, we prefer not to be there. And also, therefore, we have been arguing for exemption of the medtech sector out of any trade barriers because there's already enough pressure on the hospitals, on doctors, on the nurses, and patients already waiting for care as we speak.
Philips CEO Roy Jakobs speaking to us earlier, really highlighting the fact that any sort of clarity, this 15%, just getting a number is a positive thing. You can see that show up in the likes of their stock this morning, higher by about 10%. It was higher by almost 14% earlier in the session. The idea that there's clarity on their profitability outlook, and they boosted it. That's a rarity in this market.
Well, a few weeks ago, they were saying it's going to cost us this if we have the current level. This morning we get a slightly better level. They can understand it. They can figure out exactly what they're working with. So therefore, actually, maybe they can boost their margin guidance. So the clarity is there. It's interesting. A number of CEOs, a number of CFOs are able to provide a certain amount of clarity. Now they know what the number is. They can do the spreadsheet. They can figure out what Excel spits out. It's not Excel anymore, I'm sure, but whatever else they're working with.
What the AI tells them.
What the AI tells them, and they can go from there. So
and I'm sure different businesses will have entirely different thinking about the value they attach to certainty, won't they? Depending on their exposure to this whole trade. These trade lines. If you're very exposed to the United States, maybe you hold out for something, you would have wanted something better, or maybe you're so exposed you just take the certainty. But different businesses, I'm sure, will come out with different assessments.
So what is the economic effect? The
what
value.
Does it add up to?
What is the economic value of certainty? Well, let's try and answer that question now. Isabel Mateos-Ilago, Chief Economist at BNP Paribas, joins us to try and figure it all out. Good morning.
Good morning to you.
I'm sure we've moved on from Excel. Let's talk. How do I quantify all of this? Is the deal that we've now got better than the deal we had before? How do I price in certainty? What is the economic effect of all of this going to be? The euro got tanked yesterday by the market on the assumption that actually this is probably a negative for Europe economically.
Right. So let me unpack this because there's quite a few points. So you say, is this better than the deal we had before? If by that you mean the roughly 1.5% tariff that prevailed at the start of the year, it's definitely worse than that. Okay, so we can agree on this. If you're saying, is it better than a protracted period of trade war, escalation, continued uncertainty? No, of course it's 100% times better. So, you know, realistically, the U.S. has made clear, and this is something that has become clear over the course of time, that this was not a trade negotiation like the world was used to having them in previous decades, where everybody agrees on the objective of trading more and opening trade. No, this was the U.S. deciding to replace a big chunk of domestic taxes by taxes on imports. And so there was going to be a high minimum level of tariffs, and that's what the EU and everybody else discovered in the course of the negotiations. And once you've realized that, you try and minimize the damage. And I think the EU, the European Commission, who was negotiating, did a good job of that in two ways. One, bringing this to closure within the period that was given and ahead of a number of other partners, or at least not later. And two, by keeping the tariff at what I think we're going to discover is pretty much the rock bottom level, at least for countries that have a surplus compared to the US. But also, really importantly, and that didn't get much attention, getting clarity on the sectoral tariffs, which nobody else has. You know, the semiconductors, the list of goods like semi-equipment, the pharmaceuticals. Pharmaceuticals are huge for a number of countries.
I think we have tariffs. I've not seen anything written down yet, so we'll kind of...
Nothing's written down, but it looks like at least there's an agreement in principle for these sectors, whereas all the other countries are waiting to find out what's going to be the rate that applies to them for these products.
What happens to GDP? Does GDP go down on the back of this number? What happens to that trade surplus with the United States on goods? What does this mean?
What does it mean? So, and back to your question on the cost of uncertainty. When you look at pretty much all the macro modeling of the impacts of a tariff shock, the vast majority of the impact comes from uncertainty. So resolving that uncertainty is huge. It doesn't wipe out the negative from the tariff, but it's a huge positive. And then secondly, this is not happening in a vacuum. This is happening in a context where Europe has been taking a lot of steps to boost its own economy. You've got the German public spending. You've got now private investment in Germany that looks like it's also being juiced up by some of the tax measures and a rekindling of animal spirits. And so you look at economic indicators across Europe, you look at the data we've had on the first and second quarters, we actually think we remain confident in our growth acceleration thesis and remain quite positive for the growth outlook for Europe on the back of this trade deal.
Does this provide another incentive for Europe, Isabel, to keep pushing up its defence spending to be able to fund its own defence? And as an economist, are you factoring that in? I'm asking this partly because some people are drawing a link between the deal that Europe has accepted here and the fact that it's not balanced. Tariffs will not be the same in either direction, and a mismatch in terms of who pays for security for Europe and the United States. Is there a link between the two? Will Europe see this as another incentive to keep spending more on defence to enable it to then have more independence in other fields of operation?
Yes, so I think that's right, and I think it goes beyond defence. In a way, it was interesting to see the deluge of reactions yesterday, which expressed some disappointment that it wasn't a negotiation of equals.
Right.
Big surprise.
Yeah.
Well, it shouldn't have come as a surprise, but it should come as a wake-up call that Europe really needs to invest a lot more in its economic sovereignty. And it means, yes, more in defense, but it also means more into its own growth potential. And that's the whole innovation agenda, that's the investing in infrastructure, investing in deepening the single market. That takes us back to the whole Draghi agenda, and hopefully those who were disappointed by the terms of the deal reached yesterday will take this as another wake-up call that Europe needs to really double down on these efforts.
And what difference does the euro has been weaker for 2 days, but it was stronger for quite a long time. So I don't want to make too much of it, but it was a big move in a short space of time, and that will have an impact on the underlying economy. But people were worrying about it getting too strong until last week.
Exactly.
So I wonder how you view 115 on euro-dollar and whether that worries people.
Well, first of all, I wouldn't, make too much of a 2-day move. But it's true that you had been hearing a lot of concern from both policymakers and industrials that, this sharp appreciation in the euro is going to be a problem if it goes too far. So if this takes a bit of a pause, honestly, I think it helps digest the impact of the tariffs. That being said, our long-term view of the euro-dollar remains one of euro appreciation. But if it takes a bit of a pause and gives industries more space to adjust to the tariffs, so much the better.
How much cushion, how much insulation is there, not only from corporates, but from consumers on both sides of the Atlantic? There's a narrative here that ultimately, even with a higher tariff rate, 15% or higher, the consumer can digest it. They can absorb that cost. How much kind of insulation is there to do that?
So that's going to be one of the really interesting questions to look at in the coming months, is who pays the price of these higher tariffs? Is it the consumer? Is it the corporates? Is it the exporters? Probably the burden is going to be shared, but the consumer, certainly in the U.S., is pretty strong. Balance sheets are strong. The labor market is well, I don't want to say rock solid. I don't want to overstate it, but the labor market is strong. Unemployment is at still a historically very low level. So it looks like the consumer can absorb some of the impact for sure. But depending on sector by sector, the pricing power of companies will differ, and I'm sure companies are intending to pass through as much of the extra cost as they can, but some will, and some will be less successful.
But is there I guess what I'm trying to the point I'm trying to get to here is that there seems to be that post-COVID, the absorption, the savings amounts have come up so much that perhaps you can actually eat some of those costs, as opposed to margin compression that you're seeing on the corporate side. And I'm curious just where that starts to dissipate at a time when personal savings, for example, at least in the States, are dwindling in a fairly big way. Is there still that kind of wealth effect or that ability in people's minds to perhaps even rely on?
So I think there's going to be a question of distribution here, of the savings and of the impact of tariffs. When you look at the analysis done by the Yale Budget Lab or others, the impact of tariffs is going to be felt disproportionately by the least well-off parts of society. And unfortunately, this is also the parts of the income distribution where the savings have pretty much vanished. This is where you see the most, in fact, you're beginning to see some financial distress. So that's what's going to be interesting. But certainly those importers that have been relying on cheap imports from China and other parts of the world are likely to be more constrained in passing through the extra cost than, the luxury goods importers.
Christine Lagarde said she wanted clarity On the tariff front.
Right.
Got it now.
Yeah.
So what does she do? Are we done? Should we be cutting more? Now that she knows what number that she can plug in, you're sort of smirking because it's kind of... This has been the narrative for the last few months. What do we do? Are we done? Is the ECB kind of... Is this enough information to make a decision on whether or not the cycle is over?
So, look, September feels like a long time away, given the pace at which news has been coming. But certainly, this puts the ECB in an even better position to wait and see what happens. So, at this stage, we don't see a September cut as likely. What happens next, we'll have to see. The Q2 GDP.
Why should they wait and see? They know now. They know what the numbers look like.
Well, what do you want them to do? If they think that, inflation, as far as they see, is more or less at target, and the growth outlook, I mean, this doesn't change the balance of risks, frankly, very much compared to the situation they faced at their June meeting. Yeah. And so for them, But there's a value in certainty, isn't there? They now have the certainty. At the last few press conferences, it's been an exercise in trying to say as little as humanly possible because she didn't know what the trade tariff story looks like. She knows what that number is now. Well, so yes and no. We know what the trade tariff is for Europe. And that's very important. But remember, the EU exports to the entire world, so equally important. Well, also important is the tariff on the rest of the planet, because that's going to have an impact on demand for EU exports. They're also going to watch very closely what happens to the euro. If we were to see another leg of strong appreciation, that's a different story than if we see further weakening. And then energy prices are going to be very important. So there's a lot of moving parts.
But that feels like a more normal world to me.
But it feels like a normalizing world, let's put it that way. And in that world, if you look at the June projections, and I think we're more or less on track with those, then they don't really have a reason to cut in September. Given the projections they have, and they don't seem too worried about seeing inflation dip below 2% in 2026. But we'll get a new round of projections in September. A lot more data will have come through. And, whether there's one more cut or not before the end of the year, I think you can't rule it out. But September seems like a good time to wait.
September does feel like a long way away. We've got the whole summer to get through.
It's just a month. It's just a month.
I know.
Then we get to September.
I know. And then the kids will go back to school. Sorry,
Getting ahead of yourself.
Yeah, this is okay. Isabel Mateos, the Lago chief economist at BNP Paribas, we thank you so much for joining the program. As she said, look, there's plenty to get between now and September, plenty to get us out through the next 24 hours as well. Lots of data, ECB inflation expectations, jolts, consumer confidence. But I'm going to go out there and say I feel like earnings might be the most interesting one in the next 24 hours. I'm curious to hear what L'Oreal and Kering have to say when it comes to that tariff impact. Do they share Roy Jakobs' optimism?
Yeah, we get a bit of everything, won't we? We'll get that luxury earnings story, but we'll also get a take on the US consumer. Our ongoing questions will no doubt continue about where the pain of the tariffs is going to fall. Is it going to be on the US consumer, or is it going to be on the earnings that these companies report? And we will have to wait and see, no doubt, for the answer to that.
I'm genuinely curious to see what the jolts number looks like a little bit later.
Does it matter? Does it matter before payrolls?
Yeah, no, I think the tone will start to be set towards payroll, and I think people are going to look for different angles on that story around what is happening with hiring in the States. Jolts is as important as it once was, but I think the labour market still, I think we're going to come back to it being more important. Anyway, the Pulse is up next. We'll work you through the rest of the morning. Hope you enjoyed the show. This is Bloomberg.